Good morning, everyone, and welcome to the Manitoba Chambers of Commerce 2021 Economic Outlook event. Thank you very much for joining us this morning. My name is Peggy May, and I am the Chair of the Board of Directors of the Manitoba Chambers of Commerce, the province's largest business advocacy association representing almost 10,000 businesses across Manitoba. Today, we're very excited to be hosting Derek Burleton, TD Bank Group's Vice President and Deputy Chief Economist, who I will introduce more formally in a few minutes. Thank you, Derek, for stepping up today. We understand that Beata, TD Bank Group's chief economist, was invited to attend a crucial government meeting, so we're very appreciative that you were able to participate this morning. The Manitoba Chambers of Commerce annual economic event is always one of our most highly anticipated business insight sessions. As we look ahead amid mid-year activities, strategic planning, assessing potential risks, and evaluating investment and growth opportunities, there are always those unknowns. From destructive weather events that affect our crops to global protectionism, elections, social political movements, interest rate changes, supply chain issues, housing market surprises, you name it. We simply cannot control all the forces that affect our decision making. And this past year, we have a pandemic to deal with as well. COVID-19 weighed heavy on a global scale throughout most of 2020. Millions of Canadians were unemployed, and we've recently shed hundreds of thousands of jobs yet again amid a second wave and related restrictions. Those of us who are able to work remotely, as I do, are still toiling away at home. Many of the hardest hit sectors are once again struggling to open, and many of our independent retail operations and restaurants may never come back. New tightened travel restrictions are disseminating our airlines and our travel industry, yet some industries like food manufacturing, commercial construction, residential renovations, real estate have thrived. 2020 has been unlike anything. Sorry, hearing me okay? 2020 has been unlike anything most of us have ever seen in our lifetime, creating a deficit for the nation and our province that is almost unimaginable. Bottom line, it has created a very uncertain future, but the vaccines are arriving. We are hopeful that we will hear some positive projections this morning. A couple of housekeeping items before we get started. We have muted all participants for best audio quality. Derek will have approximately 30 to 35 minutes to present, and then we'll have 15, 20 minutes at the end where we can go through some questions. To our participants, if you have a question or comment about something that pops up for you during Derek's presentation or a concern you'd like him to address, please feel free to enter it in the Q&A function of the Zoom panel. We can manage those in real time. So now let's introduce our keynote presenter. Derek Burleton is Vice President and Deputy Chief Economist for TD Bank Group. In this role, he leads a team of economists providing leading analysis on the Canadian and US economies. In a typical year, Derek travels extensively, as we talked earlier, across Canada and the United States, speaking at more than 75 events on economic and financial developments. It's a lot of travel. Derek maintains a strong interest in public policy issues and has written substantive reports on healthcare, sustainability, education, and immigration reform. He participates in a number of advisory and steering committees, both internal and external to TD Bank Group. He received his Bachelor of Commerce from Queen's University and a Master's of Science in Economics from the London School of Economics, and he has more than 20 years of experience as an economist and respected commentator in the financial industry. Derek, over to you.
Thank you so much. 20 years of experience, and I have to say I've never seen anything like this. Anyway, I had to look. I just checked the weather in Winnipeg, a balmy minus 30, and had visions. And I do a fair amount of traveling, thinking of sort of envisaging me kind of trudging over to the venue that I'd be presenting at this morning in that kind of weather. But if there's a small silver lining, the cut in the travel has not necessarily been a bad thing, albeit I am looking forward to getting back and seeing some live people again at some point. So hopefully somewhere in the middle. But anyway, I'm delighted to be here. If we can just fire up my presentation, I'll just share the screen. I'll walk you through some of the highlights of the outlook, and I do have some good news to share. I have to say, since the December outlook, that proverbial, and I know it gets often overused, that proverbial light at the end of the tunnel, we have been seeing, and if you just flip to the next slide, some of the overview. Yeah, so this is kind of, these are kind of some of the key points. Maybe back a slide, yeah. In terms of the overview, so we put out a view in December that was actually quite a bit brighter on the 2021 outlook, and that wasn't just the U.S. or the world in general. It was Canada too. And I think one of the underlying assumptions we did change at that time was a little bit more positive view on vaccine availability, that we had a view that it wouldn't be until the end of 2021 we'd see distribution of a vaccine, at least widespread. And come December, we thought, okay, well, it's looking more positive given approvals and the like. So we pulled that forward to the second quarter of 2021. So that was good. Now that was a tension in the forecast because we knew in the near term, as the second wave got chillier, it got worse, the near term hit to the economy was probably going to be deeper. But even when you netted that out with a brighter outlook from the second calendar quarter beyond, we were left with a better outlook for the year. So part of today will be to kind of update you on some of this tension because, if anything, I've been comforted at the recent data. I know in Manitoba, we had a nice bounce in employment in January, that the data has been more resilient than we had expected through the second wave on the whole. But at the same time, the vaccine outlook isn't looking quite as bright. So I'll give you a bit of a sense for where we've landed in terms of our current thinking relative to December. Health versus economic outcomes. I think what's interesting, you look to the south of the border, the second wave restrictions weren't nearly as deep in the U.S. And certainly some of that is showing through in better U.S. economic data. So it's that health versus economic outcomes that governments have been battling with. And we know that many governments in Canada have been landing on the more cautious side of restrictions. And so that has been an element that is factored into the forecast. So I'll give you a sense as to where we see that balance going through. In terms of the pump priming, we see part of the big story, I think, this year, once we get over the hump, we get easing in restrictions. I know some of that has begun to happen. We do see the potential for a fairly big spending unleash. And I know we all worry about household debt and the like in Canada, but we do know as well that a lot of the government spending to support households has been saved. And I know it's not been across the income spectrum. It's been more moderate to high income individuals that have been saving, but that money is at the ready. Some of it, and I'm not saying all of it, some of that will get directed into increased spending once restrictions ease, and the opportunity is there to spend more, particularly in the high touch services, travel, tourism, accommodation, and food. So that's a big theme, I think, going forward. And that's where I think the outlook has probably shifted a little bit more bright than we had sort of 3-4 months ago. And risks, the balance of risks have really tilted. The US was not meant to outperform Canada in 2021 economically. But given this massive stimulus impulse, we had a $900 billion plan approved by Congress over the holidays. That is just working its way through the economy. Now we've got Biden's plan up to $1.9 trillion in additional spending. You add those two plans up, that accounts for about 13% of US GDP. I mean, the numbers are astronomical. Now that money is really going to ratchet up US growth this year. And that's probably been the biggest change since the December outlook. So I'll give you a sense as to where we landed. But to cut to the chase, the US could be growing at close to 6% this year, which is well above Canada's rate, partly in large part because of this government stimulus. So these are some of the themes that are fluid and evolving, but we'll give you the latest. And then I'll touch on some of the legacies of the pandemic, a stronger China, potential for labor market scarring. Inflation, I think, there's a lot of talk. Is this going to be inflationary, as the economies reopen and supply is somewhat constrained in areas like air travel and the like? Are we going to see prices getting bid up? Is it going to show up in higher interest rates? These are all kind of things I do want to touch on. Next slide. Now, the first thing is that the vaccine is clearly an important element. I'm not saying that our whole forecast is dependent on 70% of the Canadian population at least getting one shot of vaccine by the fall or that. I mean, clearly we need to see vaccine rates pick up in Canada. They've been very slow to start. And I think there is that underlying assumption that we will see some ramp up in the months ahead. But what you're seeing in this chart here is just the widespread variance of the rollout across the world. In Israel, and I know more focus than ever is turned to Israel than ever before. It's now vaccinated about 2/3 of its population. They've at least received one shot. The UK is leading the advanced economies at almost 1/5 of its population. Then you go down the list. So, I think clearly Israel is doing something different there. And I've got a nice chart behind this in a second. I'll share you a bit more about Israel's situation. But clearly Canada has been disappointing. There's no way about it. And I don't think all bets are off. I do see this being a significant downside risk to the outlook going forward. But, as mentioned, we do have an assumption that some of this is just early problems, and that some of the challenges on the supply side do get addressed in the weeks to come. But if you can just flip to the next slide, I think Israel is an interesting, and I think this is going to be a real test case for the world, because as you know, vaccines increasingly, while they're looked to be a necessary ingredient to getting through the worst of the pandemic, they're not sufficient in and of themselves. That you're going to need more therapies, you're going to need more use of rapid testing. And even then, I think we're, as economists, and I know that part of the challenge is we're not epidemiologists or anything. We've been having to make these assumptions on vaccines and their efficacy based on essentially what we're reading. And it is a fluid situation, but clearly mutations are becoming a growing risk. But I think in Israel's situation, and I mentioned they've done a marvelous job getting the vaccines out to their population. Keep in mind, they're 9 million strong. They're quite a small economy. So it is easier to get rollout. There is more of a centralist situation there, not as decentralized as, say, Canada or even the United States. But also they had a bit of a deal with Pfizer in particular to exchange scientific information for vaccine availability. So they've had no issue getting their hands on lots of vaccines. But I think the one point in this chart to show you is, even though you've seen the amount of vaccines on the right-hand side, I know it's been a bit up and down of late. So you see of late, you've seen it fall back, but the share of the population, as mentioned, is huge. But notice the cases aren't plummeting yet. And so this goes to my point that, I have no doubt in my mind this has been a positive thing in terms of protecting, Israel's population, reducing the healthcare crisis on a medium-term basis. But there are lags. And I think what Israel's dealing with is this UK mutation that, it's kind of kept the numbers from dropping more significantly. So, I think, again, it just reinforces the fact that while Israel will see those numbers come down quite a bit, I have no doubt in the weeks to come, it's not like you just flip a switch. You vaccinate 2/3 of your population, at least with one shot, and cases kind of drive to zero. If anything, you can see they're quite sticky on the downside. In fact, I would argue that, in cases like Canada, where you've just had restrictions in place, have done a lot more to bend the curve, and in the US, in some states, than Israel. So it's a very complicated story, and I think that's something we're more appreciating in laying out an outlook. If you can just flip to the next slide. I do think, though, as mentioned, that this is a necessary condition, and I think for me, we've gone away from this notion that you need to shoot for some kind of herd immunity, and then the light switch on and growth, then the like, to can you at least target your most vulnerable share of the population, that's age sort of 70 and up, frontline workers and the like. So that becomes the new target. If we can get those individuals vaccinated, that would be a big step forward. And then, the mutations remains a risk. Of course, that's an evolving situation. But, I think the good news is that at least the Pfizer and the Moderna vaccines have proved effective against the UK mutation. The South African mutation is a bit more questionable. But these vaccines can be adjusted over time, hopefully, providing a booster to hopefully deal with those. So it is a risk, no doubt, and mutation's always going to be there, something we appreciate more. But I still think that if we can get to the hump of vaccinating the most vulnerable segment of our population, it's about 1 in 4 Canadians. that would be a massive step forward, along with therapies, rapid testing, some of the other ingredients, and that would really help to lighten the crisis. Now, clearly, you can see the trends here that Canada is falling way behind. Don't think this should surprise you after the chart I showed you before. The U.S. should hit. They should be able to vaccinate at least a quarter of their population, so-called the most vulnerable, by the end of March. The UK is moving ahead. It has been hit so hard by this crisis, more than any other advanced economy. I mean, the caseloads have been through the roof, but its centrist government has been able to implement quite substantial vaccine rollout. It should be able to hit it by the first day of spring. Whereas Canada, I think, and again, I'm worried that maybe this isn't even achievable given some of the supply constraints on imported vaccines. We should still be able to hit it by the end of April. That may be early as mentioned. It could be more of a story in May or June at this stage. But again, we are listening to the word of companies, the Moderna, Pfizer's, that they say they're going to make up for some of the shortfall they've been experiencing of late. And then you have the potential that isn't even factored in here of J&J, Novavax, some of the other vaccines that should get approval soon that Canada does have orders on. So that could offset on the other side. So by no means are all bets off, just given the very low trend in vaccinations. We're running at about 30,000 a day. We need to see those up around 100,000 to meet this target of late April for addressing the most vulnerable side of the population. So risks on both sides, but this is still an underlying assumption in our forecast. Next slide. The provinces, we're also kind of listening to any kind of guidance coming from them. Again, based on, they listen to companies as well, and they come up with, to the extent they know, any kind of guidance on when they should be able to target, or reach, at least the most segments. You kind of go down the list, and most are in kind of that April, May. Not all have released guidance. In the case of Manitoba, I think our assumption is it will be early April, given the vulnerable population. The doses, it's largely been done on a per capita basis until lately, but that's kind of our underlying assumption is early April. But again, lots of risks around this as part of the uncertainty that we're facing. Next slide. Maybe just skip ahead. Yeah, thanks. So coming back, so that's our assumption, that we're still optimistic that we'll be able to manage the worst of the health crisis. No longer is there any kind of notion that they'll be fully eradicated by the end of the year. But if we can address the most vulnerable segments, that'll allow hospitalization rates to come down, allow restrictions to get eased, and that should be a trend. Even if we don't, we still have restrictions lagging. That doesn't mean you can have a very significant growth pop in countries like Canada, given the still low levels of activity. And that's what's embedded in our forecast. This gives you a sense for 2021 and 2022, the evolution of our growth forecast since our last official published forecast in December. And that shows you that the US is leaps and bounds seeing the biggest upgrade. That, in fact, the 5.3 we're now looking at for the year ahead, 2021, is probably going to look more like 6%. Just given that we had only built in $1 trillion of the $1.9 trillion stimulus that Biden is trying to get through Congress at the moment. But given that they're now going to be using that process of budget reconciliation, the U.S. is a very complicated place for politics, I have to say. They've got all sorts of checks and balances and processes and the like. But even with only a slight majority, that's all they need. If they use this process, which you can use once a year to get through massive money legislation, that would mean only 50+1 votes are needed in the Senate. And I think our initial assumption was that they would want a bipartisan approach, at least to start. That seems to have gone by the wayside to just, requiring Democratic support to get through the Biden plan. So now we're assuming that the bulk of that 1.9 trillion gets implemented, and that could take growth rate up about 2 points relative to our expectations. That's a massive amount of growth for an economy that wasn't hit nearly as hard in 2020 as Canada. Canada, we're still looking relatively positive at close to 5%. Again, this assumes after a slower start to the year that we see growth pick up beginning in the second quarter and kind of running a faster growth track over the course of this year. Europe is more challenged, downgrades there likely, and that region was harder hit in 2020, given much more severe lockdowns on average across the region into the early part of this year. And Japan, very similar outlook. The UK as well, we're downgrading. And then 2022, upgrades, slight upgrades we'll be looking at. Again, the view longer term is that provided we don't have some massive additional wave and massive lockdowns, a real push, that growth should remain strong through 2022. And of course, you're getting into some of the what ifs and downside risks around the evolution of the pandemic. So my confidence in 2022 goes down a bit. I think 2021, I feel a little bit better about in terms of confidence. Next slide. Just a couple of the highlights around the world. Europe is facing a double dip recession. In Canada, I'm feeling that we're going to avoid any kind of near-term contraction in growth. I think the resilience of the economy, and I'm not saying all economies through Canada have managed that second wave. We know Manitoba did feel a bigger chill from very significant lockdowns. The governments were pushed to dealing with a very violent second wave, relatively speaking. But Canada-wide, the numbers have been resilient. Europe has been hit harder, more visibly in the data, and we're looking at actions both in the fourth quarter of 2020, and that's what we've received already, and the first quarter of this year. That region is going to be slow to come out. They've got a massive stimulus program, but that's unlikely to kick in until 2022. So Europe is going to be an underperformer this year, and a strong currency and the like don't help relative to the US dollar. Next slide. On the flip side, China has been on the other side of the spectrum, more V-shaped in its recovery than anywhere else. We are seeing some signs that it is beginning to slow down. The consumer's lagging a bit. Really, it's recovery that's been led by the business sector. A lot of the stimulus has been oriented towards investment. A lot of the goods China produces have been highly in demand, whether it's electronics, PPE, and the like. So it's benefited as well from its export mix. And one of the legacies of this crisis is that China will continue to become more important in terms of the world's share, both GDP and trade. On the right-hand side, you can see that by where we currently sit, 2022, it's almost accounting for 18% of global trade. And its share of the world output as well is going to hit close to 20% as the U.S. falls back a little bit, albeit maybe not as much given the U.S. Strength this year in terms of its rebound. But the U.S. probably will be around 50% of world output. You can see that gap is beginning to widen. China, of course, retaining leadership in areas like high tech and the like. So one of the takeaways from here is that the talk tough on China is not going to let up anytime soon. With China becoming even more important, there's going to be obviously some jostling for international position. And Biden has signaled that himself, that the pressure should continue as China should be continue to open up and become a fair trader on the global scene. So that'll remain a theme, I think, in the year ahead. Next slide. So the stimulus, and it's both Canada and the US. So, I'm sure in some of you are thinking about where is this all going to leave us in terms of government debt, going to be kind of that longer term vulnerability and how that resolves. I think we can have probably an hour-long discussion on. I think it's becoming quite clear to me that if anything, the deficits are going to remain even higher over the next few years than governments have been signaling overall, particularly central governments and the like, as they'll be continuing to kind of deal with some elements, legacies of this pandemic. And in Canada, for example, the pressure to increase health transfers, a lot of the pressure to help the provinces manage their budget positions is just going to continue to grow. But in the short run, it's about opening up the vault of spending to ensure growth remains on the recovery track. And I think part of it is the logic of if they allow the economy to stay too low for too long, you can get into a deflationary situation, and that becomes very difficult to get out of. It can take years. Whereas if we do get a bout of inflation because of too much stimulus, then that can be addressed through, raising your interest rate a bit more than planned. So, and you listen to groups like the IMF, the OECD, they are preaching for governments to continue to spend, to deal with long-term challenges, invest in infrastructure, spend while the window is kind of open in terms of extremely low borrowing rates. I am a little bit older school in that regard, that I do worry about, it is fine, and I can understand the logic of spending a lot now. It does help, the economy to recover. If you can get an economy running hot again, it benefits in terms of dealing with inequality and the like. But at the end of the day, this is not a sustainable trend that'll have to be addressed. I will come back to that in a second in terms of how that might resolve. But all that to say, in the short run, and I know there are a lot of bars here, you're not going to get tested on any of this, but I would focus on the lime green. It's sort of the TD color bar in the middle for the US, which includes really all the stimulus. No longer, I think, are we talking as much about, what are the scenarios that can unfold with the Biden plan if they needed Republican support. It's clear that the bulk of that 1.9 is going to get implemented. And the US, by the way, will be looking to raise taxes to pay for some of this. That's probably more of a story for phase 2 of the Biden plan, which would probably be more of a 2022 story. At the earliest. So that would be the other side of the valley. But in the short run, it's going to really ratchet up your growth up to the 5.8. This is fourth over fourth quarter changes in GDP. And then you're going to get a bit of a growth pullback in 2022 as some of the stimulus wears off a bit. But still, it's still decent, 3%. In Canada, one of the guesses we have to put in for the moment is the government there, through its recent update, indicated it's going to be spending a fair chunk of money, and it's announcing it a little bit more detail in its upcoming budget. And what they did signal in the fall is that they'd be spending between 70 to 100 billion in additional money on top of their existing stimulus. And that could really, if that kicks in, say in 2022, because it wouldn't likely really kick in into earnest till then, Canada's growth could really be ratcheted up. Now, we haven't embedded that in the forecast. You see the 5.7, which would include all full 100 billion. But we will as that budget detail comes out. It's too early yet. But again, this is the kind of impact it can have on the short run forecast. Is restrictions are eased, private spending is getting running again. You get layered on top a lot of government stimulus. Again, deficits run higher in the short run, but it can have a huge impact on growth forecasts. So yeah, a little bit positive here. But, again, there are risks. I mean, if we get mutations that can't be addressed by vaccines, third, fourth waves, then the government may be spending more, but your private outcomes are going to be quite a bit weaker than what we've guesstimated in this round. Next slide. Now, the housing market, I'm going to get into some of this K-shape because we do know all sectors have been operating very differently in Canada. You've had at the high end, you've had non-durable manufacturing. You mentioned food exports. Those have been areas that have vaulted way above their pre-virus levels. And housing is one of those that we've seen, if anything, a checkmark kind of recovery where we saw a couple months down and then all of a sudden its sales have gone way above their pre-virus on the one hand. On the other hand, you've got airline transportation, the airline industry, operating at still a fraction of where it was pre-virus. So very much a K-shaped recovery. This has been the letter, I think, that's been most apt of all the letters that have been thrown around to describe it. But let's cover, to start with, some of the resilient areas. And I think housing have obviously featured front and center, and this would be included in the Winnipeg outlook, Manitoba broader. We've seen actual sales run well above fundamental sales. The fundamental sales are driven in our model by things like interest rates, population, a lot of the fundamental drivers. And look how far sales have rebounded. Now, you can argue this is just made up for some of the losses during the spring of last year, but I would argue that there is some staying power here, at least over the next few months, that are going to keep sales elevated well above what our models are suggesting they should be running at. It can't last forever, and you would get some convergence, given affordability is eroding. And I think the bigger thing is just a lack of supply. Look, a month of inventory of Canadian sales on the market. As sales have rebounded, it's really eaten into existing supply. And I know that it would vary depending on market. condos in places like downtown Toronto are seeing supply go up because people are flocking to single attached in the suburbs and the like, that race for space. But overall, even when you net everything out, supply goes down. That becomes a bit of a constraint on sales going forward because prices of anything are just going to get ratcheted up even higher. And so I have to confess, we've thrown in the towel on our housing outlook. We had a real adjustment in home sales beginning kind of at the tail end of this past year as affordability constrained, and we still had a second wave and the like. And once the pent-up demand was exhausted from the initial stages of the rebound, but that hasn't proven to be the case. And I'm wondering if our models aren't picking up things like millennials and some of the higher home ownership rates and still low interest rates, wealth effects from rising condo prices, allowing people to move up into semi or single attached. So these are factors I think aren't being fully appreciated by our models. So all that, if you flip to the next slide, you are dealing with quite an upgrade in our home price forecast. Believe me, I don't like to implement. Usually our forecast changes are more gradual than this, but we basically went from a home price adjustment. You can see how that on the left-hand side, the line kind of comes down. We had expected, particularly as some of the single attached fervor would die down, a bit of a compositional shift back to condos, particularly as vaccine rollout continued. That is now off the board. Now we're dealing with further gains in the year ahead, with some flattening in the long term. So we do not build in any significant price adjustment. Now, some of the risks around that would be if interest rates were to rise more sharply than we expect, and I'll cover that in a second. We do have at least medium-term interest rates edging up in the months ahead. That'll be a bit of a constraint on sales along with supply, but it's not going to be enough at this stage to really jolt the market into a pullback. I think you'd need something bigger than that. In terms of the right-hand side, it shows you that we've thrown in the towel virtually in every region, including Manitoba, where we had a smaller price adjustment, granted, than we had in other provinces for the year ahead, 2021. Now we've got a further gain, and that just reflects starting point, the momentum heading into the year, and the fact that we're building in more resilience in the near term. So this is a sector that's going to continue to help support underlying growth, the recovery in places like Manitoba and Winnipeg. It's going to help new home building, relative to our prior forecasts where we put more weight on other sectors to carry more of the growth baton. Next slide. I'm just going to pick up things because I know there are going to be some questions at the end of this. So I'm going to touch on kind of the high-end themes here. I don't think there's a lot to add here. I think all this chart shows you is that sales to listings, that's a measure of supply demand, are well above historical. Anything above 60 is a seller's market, and pretty much in every province, maybe the sole exceptions of Newfoundland and Saskatchewan, are running at the high end of balance or a seller's market, and Quebec is at the ultra high end. And so that just shows you the strength on the sales side has really happened despite tight markets, but we have seen it show through in well above expected home price gains. Next slide. Yeah, just this theme I mentioned on spending, because I know a lot of your businesses rely on consumer spending. It is part of our forecast that does brighten. And I confess, there are uncertainties around it. You've got many households that are going to make their way through, much as businesses, with holding too much debt. Some are, facing real hardship. They haven't already. I mean, deferrals kind of begin to end on, or have been ending on some of the lending products. Interest rates are going to edge up. These are all kind of constraints, but the one thing that we do build in, two things in fact, are excess savings that have been set aside, partly through government support programs. Governments were quite generous through the crisis. In some cases, households seeing well above 100% replacement rates for lower income if they went on CERB relative to staying on their jobs. Some of this money has been set aside. Partly it's just been through a restricted economy. You haven't been able to spend in a lot of the high touch areas. So you have excess savings that is willing to spend. The other thing are restrictions. And the chart here, the point of the chart here is just to show you that restrictions do matter from spending, even in areas that have been so strong like household goods. As people have been buying homes, they've been furnishing them. But you can see the latest round of restrictions in Ontario, Quebec, Manitoba's included, being one of the four provinces, Alberta, which implemented tougher second wave restrictions. You compare those to the provinces that didn't restrict as much. That's the dotted line. You can see that real yawning gap in spending performance in recent months. You know, we do know that employment has been hit as well. These provinces that tightened up with second wave restrictions more significantly. So it has created a real divergence in economic performance. The assumption is going forward that as we ease, and I know in Manitoba, we're now beginning to see things ease up a bit, which is great news. Ontario as well, we're lagging a bit province. That should narrow some of this gap going forward. And I just saw a chart on that. It eased up on restrictions on restaurants on 25% capacity. Our real-time indicator showing restaurant spending surged almost overnight, just showing you the kind of quick impact it can have, given that people are probably dying to get out and sit in a restaurant. You know, albeit, you know, obviously the social distancing measures are still going to be very much, but just shaking things up and getting out to a restaurant, I think there is some pent-up demand for that, as well as some of the other areas that as restrictions ease should benefit. Next slide. Yeah, the wealth effects are another factor that help households. I know the debt levels are still extremely high in Canada on average. It's a challenge. But wealth effects do make people feel wealthier, and a good 5 cents of each wealth dollar created tends to get spent as easing restrictions happen. So it doesn't matter where you're looking at in terms of, oh, I apologize. Somebody in my family is printing something right now. Guess I should have told them I had a presentation. Excuse that distortion in the background. But all that to say that it's an everything rally, and it's benefited everything. And the savings rate on the right-hand side, we saw savings rates in Canada run from kind of a low before virus level of about 4% running to well in the double digits. This goes to the savings excess I've spoken of. Now, if you assume only 10% of that excess savings that has been accumulated gets spent, so 90% doesn't, that's going to be kept as precautionary or go to debt, addressing debts as forbearance ends and the like, that even if 10% of that gets spent, it can lead to a huge impetus in terms of spending. If you go to the next slide, you can see. Yeah, we've just been running various scenarios on spending, and we kept cautious. But if you assume that a reduction in the savings happens more quickly, you can get much stronger growth. This is the kind of world we live in where, even though I've kind of provided pinpoint forecasts of growth for Canada, huge variation exists. But this is a huge impetus. And obviously I've touched on some of the downside risks, so it's not all upside. But that dotted line shows you that if you get a return to more normal savings rates over the next 1 year and about 10% of the saving, the kind of impact it can have on terms of consumer spending profile. That assumes, again, restrictions continue to gradually ease and the like as well. Next slide. K-shaped recovery, a good paper on this we just put out earlier this week, or maybe tail end of last week, that ranks industries in Canada, 27 industries, by where we see output performances over the next year or so. And I think one of the key themes there is some of the K is going to get squeezed as some of the high flyers, the medical equipment, obviously, that's still going to grow rapidly, but naturally it's been growing so rapidly, there's only so much upside. But the bottom dwellers, the high touch services at the end, which are still running at 25% below pandemic. In the case of airline, it's running, my goodness, I think about 25% of pre-pandemic. That's 25% of its pre-pandemic, if even lower, and that's been a rebound off 4% in April of last year. But even if you get a huge bounce in some of these in growth terms, it still leaves levels like the high touch. I think we've got something like a 60% growth rate by the end of this year. But in terms of its level share pre-virus, still a fraction. So it's just that levels are so low, you can get these heroic growth rates going forward as restrictions are eased. So you will get some easing in this K pattern, but it's going to take at least a few years to see more of a normal shape recovery pattern, probably 2022, 2023, where you get airlines getting even remotely close to where they were, accommodation and food. That's probably a 3 or 4 year trend. And as we know, even within industries, big changes in terms of within restaurants, takeout is still going to probably be more important as people have adjusted their behaviors. So one can examine each industry to talk about the big shifts with automation and the like But all that to say that these are aggregate output levels. You'll see some rebound going forward, but not fully making up. And I don't think I'm going to surprise too many people when I say that. More detail, please refer to that report on our website at td.com economics. Next slide. Yeah, investment is still a worry. Canada, we compare Canada to the US, which we often do. The US has seen a real recovery in investment already. In Canada, it's been very slow. Now, I take heart in that dotted line on the left-hand side, which is Canada. That's the Business Outlook survey. Do suggest that big companies, I think they're the ones that are surveyed in the Bank of Canada quarterly survey, but they do anticipate a bit better outlook for spending than the hard numbers, which is the green bar, still shows deeply in decline territory. And this is overall investment, includes structures, includes machinery and equipment. But I'm hoping that we do begin to see a pickup beginning in the second quarter. I don't think it's a first quarter story. But look at the US, they're almost back to pre-virus levels in business investment. Again, just kind of speaks to one of those Achilles heels in Canada, which is we don't see enough private investment in Canada. And for reasons that we don't fully understand, I have to confess, we've been studying this for 2 decades and still trying to figure it out, albeit, we do suspect certain things like provincial trade barriers, things like that get thrown into the potential mix that we need to address to see investment grow more on a trend basis. Next slide. Just rounding to the end here, a couple of quick points and then get to financial markets. Scarring will be an issue. So, by no means you see these nice bounces in growth. It's off low levels. Things like unemployment rates won't even get back to pre-virus levels anytime soon. Now, the one exception may be the US. With 13% of GDP being spent in stimulus, you could see unemployment fall more dramatically than we show in this chart. Some have even suggested it could go below 3% a year from now. And that's into above full employment territory. So that's where you start to get worries about inflation abounding. So this is really more of the risks on the inflation would be stateside relative to Canada, where you're seeing less, even though the government's spending federally, provincially, we're seeing big expenditures. I know in Manitoba running a deficit of 3% right now of GDP. It's still nothing compared to the massive stimulus underway in the United States, where they're pretty much saying, okay, we're going to cram this through. And if we can get back to full employment, that's great. If we can get wages up higher, that's great. And we'll deal with some of the inflation risks if they do manifest going forward through adjustments in monetary policy and the like. Next slide. Yeah, just a couple of quick charts in Manitoba. I won't belabor it. I think, we've seen Manitoba, the province lost about 100,000 jobs in 2 months in March and April of last year, saw a much more heroic rebound. And then the second wave hit and 20,000 jobs were lost at the tail end of last year. We saw a 5,000 bounce in the latest employment, which is good. Unemployment rate came down a little bit, which is good. So I'm hoping province is in for a little bit of a run as restrictions are eased. I'm not getting too excited about unemployment falling dramatically. It's still about a point above where it was in October of last year. So it was running at about 7%. It's now back up to about 8%. But Manitoba has been harder hit than most provinces through the second wave. So again, hopefully going forward, we do see a bit of a recoup there. So I'm hopeful on that front. Next slide. Yeah, just shows you employment levels in Manitoba. You got that second dip, and now we're seeing a bit of a rebound. Hopefully that continues. Next slide. Yeah, drop in employment levels. Manitoba ranks in terms of relative to pre-virus, the worst. So again, one can get too down on where we've been, and I know it's been a rough ride. Thankfully, GDP didn't decline quite as much, as some provinces. So, with GDP rebounding in the quarters ahead, my hope is, and our guesstimate is, and we do build some of this in the forecast, you will get a bit bigger bounce in employment over the remaining, 11 months of this year overall. Again, doesn't change the story of that kind of slowish recovery back to pre-virus levels, particularly in the labor markets, and some of the transition of low-skilled workers and some of the longer-term issues that come of that are still a challenge for hiring and for employers. But I think all this suggests to me is that going forward, things have to get better. I mean, as you can see here, the worst performance in the last year relative to pre-pandemic. Next slide. Yeah, I just on debt, I think it's a worry for me long term. We have seen a lot of debt growth since the pandemic, and I know that 2020 was supposed to be a year where households kind of laid off a bit of debt accumulation, but then you had the pandemic hit, and if anything, a lot of the supports were oriented, particularly for business, to allow them to borrow more to kind of keep solvent and the like, or keep operational, I should say. So, a lot of the government, vehicles put in place have helped, but if anything, have only increased debt higher. This shows you economy-wide debt growth over the last really since the end of 2019 by country. It shows you Canada ranks third behind the UK and Japan for adding to debt. It was already a high level of debt to start with. So again, where does this leave us? Well, a few things. Rates are still low, so that's one reason. So some of this debt has been allowed to just through a better than expected affordability. We had higher interest rates in our medium-term outlook a year or two ago than we do now, with all the government supports and the stimulus put in place monetarily. But if yields do come up, and I can't predict when that's going to be, any kind of big hike up in yields, this is a vulnerability, and it may not be in the equation for the next year or so. This is going to be potentially a medium to longer term risk. It does suggest that the best outcome would be to kind of cool the jets on borrowing going forward and allowing incomes to catch up a bit. That's the best outcome, and you hope you don't get hit by any kind of major shock. For example, governments, if we were to have another big recession, their debt would only go higher. And so the government portion, which you can see as the lime green part of that, would go up even higher. So this is all vulnerability. One can't predict a turning point with any kind of vision. It doesn't seem like it's something, as the windows are open, financial markets, risk appetite and the like, not a lot of pressure on governments, households and the like to kind of cool their jets. And recovery is, if anything, going to help support the debt that's been accumulated. But it just is, this is a longer term vulnerability for Canada as it is for Japan. I mean, that's been an age old story, hasn't it? But anyway, just some thoughts on that front. Next slide. Yeah, just the debt levels. This just goes to my point. Debt is high. I don't think I need to speak. This is a government picture that shows time series. U.S. highest debt level since the Second World War. And that is, by the way, that's the gold diamond. That's the U.S. debt level that's expected. That's going to be ratcheted up as we build in the 1.9 trillion. That's not even included in that. So Canada's debt is going to look even lower relative to the U.S. So households have higher debt in Canada relative to our American counterparts. The U.S. federal government is going to have much higher debt relative to Canada. So there's a bit of an evening out to some extent on that front. Next chart. Yeah, just on rates, and I'm going to summarize. I mean, you got all these economics expressions on the chart here. I think the point of this chart is to suggest that even with growth rebounding, interest rates, short-term rates are going to remain effectively zero for at least another few years. I think our current assessment is 2023-24 for rates to be nudged up, and we keep lowering the medium-term outlook for that relative to what our models would have suggested before central banks have kind of shifted their take, allowing inflation to climb a bit higher. If they, for example, allow inflation to climb above 2%, which traditionally they haven't allowed to, or at least targeted, there's more openness to allow inflation to rise above 2 in the US and Canada and other countries. It may mean short-term rates remain lower, but it is a risk on inflation. We could have more pernicious inflation than we forecast, and also higher longer-term yields in the forecast than we forecast. If you just flip to the next slide. So short rates, I don't see a lot of risk. I think if anything, it's more on 5-year rates and beyond. 10-year yields could go a bit higher. The question is how much and whether we built enough into our forecast. The chart here shows you the U.S. risks on inflation are where our eyes are particularly fixated, because this huge amount of fiscal stimulus is going to push on the right-hand side the U.S. into a position of excess demand. That's left-hand side, right-hand side, and you get inflation likely climbing above 2%. So in effect, the Federal Reserve is going to achieve what it wants to achieve. I think for me, the question is, do things work out this cleanly where inflation only rises to 2.5%, which again is tolerable by the central bank? Do we get 3% inflation or 3.5%? And I think there's a bit of an experiment going on now, and I am more concerned about inflation being higher than projected than lower. I see a risk being skewed to the upside, but we need to be mindful of these risks because while our models suggest inflation won't pick up dramatically, given that expectations are still fairly well anchored, whether they're survey-based or even market-based, that can change quickly. And if it does, yields will price in more risk to inflation, and yields could jolt up. Now, even if the US is more of the risk at the moment, Canada would see yields move higher on our side of the border because yields tend to trade off the spread off US yields. So if that bar goes up, ours goes up. It may not go up as much, but it will go up. And for an economy that's so set on rates remaining low, given the amount of borrowing, it does represent a risk, at least over the next year and even beyond that we see higher rates that really do jolt. And then what would happen? The economy, I don't think, could sustain it, and then yields would fall, but we might be in a recession. These are all risks to our baseline outlook. So I show you inflation climbing in the US and Canada would look a little bit like this, up to 2% or a bit higher. But we need to be prepared with all these tailwinds on inflation, all kicking in together. It could be a little bit bumpier than this ride. We do our best under the uncertain circumstances. Next slide. So yeah, the yields, this just shows you the yields this is a 10-year treasury, which is a real benchmark yield. You can see how the lime green line shows they've increased. They're up above 1%. The low during the pandemic was about 0.5%. So they've more than doubled off their low, but they're still low. And we have a year-end target of 1.5. So we have another 50 basis points or 40 basis points. Canadian yields as well, the 10-year would go up. Even if short-term rates get held at effectively zero, we'd have about a 30 or 40 basis point increase in yields effectively off the US yield spread. And so you need to plan that in. I think yields have backed up a bit, but we do expect it to continue as recovery continues. The question is, if the inflation expectations, which is the top end of this curve, if that goes up higher, yields will follow suit. So we're not assuming, we assume that markets have rationally built in the stimulus already, but they may not, and the actual measured inflation may poke up higher, and that would drive up in expectations as well. So those are the risks around this. So yeah, there's a general view on yields. And this is the last slide, and hopefully we got some time for questions. Just on Canadian dollar, we've had a view that the Canadian dollar would average about 80 to 81 cents in the year ahead. And that has been based on a December view that the Canadian economy would see a nice rebound, even exceeding the US in the year ahead. But that forecast is shifting. So if anything, we're kind of lowering our Canadian dollar forecast a little bit. We still see it holding close to current levels, but sustaining something above 80 cents, I don't think is going to happen this year. A little bit lower, which I think is beneficial to exports, beneficial to a lot of our key export areas in agriculture and the like, which we do build in a pretty good year. I think that'll be a support, at least on the crop side. See some good tailwinds there. But all that to say that oil prices probably will flatten out. That's been a huge impetus to drive currency up to about 78. Don't see a lot of further upside from these levels, given that U.S. growth is likely going to exceed Canada's, and that tends to be a tailwind for the U.S. currency. So making some modest adjustments to our Canadian dollar view. So Chuck, I'm going to stop there. I know there are a few questions, and unfortunately, the time I don't see in front of me. Let me just click that off. Apologies.
Yeah, it's just we've got a couple of minutes. If you're able to go a little past 10, that would, or 11 your time, I guess that would be terrific. I really appreciate, Derek, you taking the time and very in-depth presentation for us today. So we do have a couple of minutes, and I just wanted to maybe touch upon a couple of the elements that you talked about. So obviously, this has been let's just kind of start from the perspective of in your role as a deputy economist with TD Bank. This has been must be a very different year in terms of trying to predict what's happening in the economy with, and you touched on it a little bit as well, just with obviously with the COVID situation and then with the vaccination, in terms of just talk a little bit about some of those detriments in terms of how they potentially impact how quickly the economy comes back, specifically in regards to the vaccination issue.
Yeah, it's, I'm feeling better. So the vaccine, I'm more worried about. We had a view in December that, vaccine rollout was going to happen aggressively. And those numbers are being undershot. So we still have the hope that you're going to get some makeup. But, So I'm more worried about vaccine rollout. Where I feel better, Chuck, is on the resilience of the economy to weather it. To give you an example, second wave in Canada, we are seeing fourth quarter estimates for GDP in Canada ratcheted up to 6 to 7%, where we has had a view of about 2% before. And that's through the peak of the second wave and into the early part of this year. So the data that we're getting coming in has been more resilient on the whole. I think we're adapting. We're starting to adapt as an economy. So I'm not downplaying the stresses on a lot of key sectors, but from an aggregate 50,000 foot high level, we're learning. And I think the resilience, are playing through to some extent. So that's offsetting a bit of the risk on the vaccine side.
And has that been one of the key elements as well? I know in my role, talking to businesses on a daily basis, that the pandemic has really impacted certain sectors more than others, and there's no question about that. And when I talk to some business owners, it's either it was the worst year of my life or it was the best year of my life from a business perspective. Does that sort of balance it out when you're looking at the Canadian economy and how quickly it's able to rebound?
Yeah, it balances it out for sure. It's that K-shape, but I think at the same time, we don't do a lot of the charts that showed your aggregate numbers. We don't do it justice. For each one in labor market, you could separate into the winners and losers. We know that's really been the story of the pandemic, the inequalities, what have you, and that would stretch out to the sectoral performance. But so in a sense, it's made our life more challenging in forecasting. We're doing a lot more bottom-up forecasts than we typically do. Usually it's, okay, what's the aggregate view on conditions? How will that then work its way to provinces and industries? Now we're doing more industry assessment and working our way up. But clearly, all I can say is my hope is you get some significant convergence going forward as restrictions get eased, because these sectors at the low end are still very depressed.
Derek, in your slides, you referred to Canada's slower return and that sort of 2022 lift. And, I guess from your, expert perspective, how do you think the federal government's, sort of COVID response has performed? And are there things that they could have done differently? Is there parts that are missing in that recovery plan right now?
Yeah, it's a great question. I think, looking back, I think there'll be a lot of analysis. I think in a perfect world, the stimulus through the early parts of the pandemic would have been more targeted. I think, if anything, the spending has been huge, but I think their view was like a fire truck. They're never accused, fire people are never accused of using too little water. So I think that was under their mandate. We do know that probably there were some inefficiencies to spending. The one area I think we got to move going forward is to more targeted supports as we move through the pandemic. And I think small business is an area that I think there's probably the most need to kind of ratchet supports away from the household. Ongoing supports for sure, but in terms of the thrust of focus, and that's something that, governments, I hear advice all the time when I go to these meetings and with finance ministers, it tends to be small business probably needs to continue to see even more support, relatively speaking, to the total pie.
You talked as well in your presentation just about what the U.S. is doing in regards to helping to stimulate their economy and the massive amounts of dollars that they're putting in. A lot of that is going directly to Americans in terms of sort of almost like a rebate program, and knowing that Canada still hasn't really put out its sort of stimulus package yet to really rebound the economy. Are there things that, from a TD perspective and from an economist perspective, you would be encouraging, the federal government to be looking at in terms of what their stimulus is going to look like in this upcoming budget?
Yeah, I would imagine the next wave, similar to the, obviously in a large extent, very different circumstances. But, I think going forward, we just saw an announcement today, I think, just caught it before I signed on, that the federal government are providing provinces through provinces to cities support for transit and the like. So, healthcare. So I think probably a lot of the federal supports will be for helping provinces. Healthcare, they've still got to make decisions on infrastructure, through the infrastructure program and through that's going to be the thrust. And I don't have any problem with that. I wonder about tax rates. There's a whole other tax side of the equation to wonder. So some of this, I can see that being certainly a risk going forward. But in terms of the supports, that's going to be the next wave. And I think that's a pretty easy guesstimate at this stage.
One of the other areas as well, we see, obviously with our biggest trading partner being the United States, the change in the election results and the new president being in place for the last month, and one of the things that what President Biden has talked about is sort of bringing back this sort of Buy America policy. And obviously that's created some issues, whether it's Keystone Energy being one key element. But I'm just curious as well, as that biggest trading partner, as we start to, the economy goes forward, is that going to have a much larger impact than we think on Canadian economy?
Yeah, I mean, just the optimist in me. I on Buy America, I mean, it's certainly something that I think we were all kind of braced for. I think every single president has, and I know there have been exemptions provided through the Trump, and Obama had them. And so I'm not surprised this executive order was fully expected. One thing I would throw out is that, even when we were allowed exemptions, I think the latest data were 2016, I think Canadian companies only won something like 600 million in contracts through, the sort of the U.S. infrastructure that has been part of this Buy America. So it's not like it's 40% of our GDP or anything. Not to belittle it, it's still important to companies. But I'm optimistic. I'm thinking some of the bad news. Again, Keystone wasn't surprising either. They had problems, but I'm hoping now Biden and Trudeau will get together and start working through areas of because I do think Biden is not the one that's going to want to create war with Canada. I can see him being somebody to kind of work with a partner like Canada. Now maybe we get the next wave where we get, maybe more cooperation areas, CARB, that stuff. So hopefully that'll be the next wave.
Derek, maybe just a couple of quick other questions as well. You kind of spoke about the possibility of future lockdowns even after the vaccination, and I'm just wondering what type of modeling your team is kind of doing for 2022 you provided. But do you look 5 and 10 years out in terms of how we continue to sort of rebuild the economy and how quickly it does rebound?
Yeah, it's a great question. We've actually waited. We do have long-term forecasts, and we've been waiting a little bit for the dust to settle. I think the general view is that the pandemic would impose costs on longer-term growth. We'd be bringing down the longer-term cruising speed of Canada, the U.S., given some of the scarring. One thing I'm optimistic on, I can see productivity with all the shift to digital will pay off in terms of some productivity benefits over the long run. Immigration is another key area. I think based on the federal immigration targets, the hope is we'll get back up to a firmer rate of growth that'll help the labor supply part of the equation. So I'm wondering if those numbers are going to come down as much. I think over the next few years, there's reason to be concerned about a lower trend cruising speed under the surface. Longer term, though, I'm hoping we'll see some offsets, even if, again, industries, their cruising speeds vary relative to pre-virus quite a bit.
Just maybe to kind of wrap up as well, Derek, I think one of the things that we're seeing, in terms of how businesses have had to adapt is, and you kind of just touched upon it, is just, that adaptation that businesses have had to go online and to have that digital presence. And, I don't think we're going to be going back to sort of that bricks and mortar model any longer. More people working from home for longer periods of time, kids learning from home. That's kind of been the biggest surprise from my perspective, is how quickly that's come about. In your presentation, you talked about, the housing, what's going on with housing. Is there anything specific, as you kind of reflect on, we've been in this pandemic for the last 11 months in terms of, from an economic standpoint, is there something that sort of popped out and you go, well, we didn't expect to see that, or there's a trend that we're going to see that's going to continue going forward?
Yeah, there's nothing. It's a great question. Just trying to think if there's anything. I mean, I've been amazed almost every day, and we've taken advantage of so much more data sources than we ever have, whether it's real time and the like. If you had told me an unemployment rate in the double digits in Canada and yet spending kind of V-shaping back, I wouldn't have believed you. But this just goes to show you how unusual the circumstances and where our models are running into problems, because they're all driven off these past relationships. A lot of judgments being used. I think the resilience is part of it. I would have hoped that, we would adopt as an economy. And again, I don't want to come across as just being Mr. Positive, Mr. Optimistic, but I have been, I think it's been good to see that the economy under this, all these restrictions in the wave, and we've seen impacts, but they haven't been as bad as I would have guesstimated. They were initially for April, May, boy. But as we move forward, this just shows you that even if the pandemic doesn't completely get eradicated, we're going to hopefully get back to those pre-virus levels, not quickly enough for many, including myself, but at least by 2022, we'll be back to a more normal level of activity, even if the economy is different, as you just well put in your comments.
Derek, thanks very much for spending some time with us today. It's been great having TD Bank, a strong chamber partner, and having the ability to share with our members where the economy is going in 2021 and into the future. So I know we're going to throw it back to Peggy, and Peggy will just wrap up. But just a huge thank you for taking the time this morning with us.
Thank you so much.
Thanks, Chuck. And thank you, Derek. That was an excellent presentation, really informative. We're very grateful that you were able to join us to contribute valuable perspectives and expert insights today. Now more than ever, we must work together throughout the business community to support and determine how to move forward with resilience. In spite of the overall level of optimism Manitoba's business leaders reported in our Business Outlook survey last year, we know there are key sectors that are really struggling, and we are experiencing pandemic fatigue overall. 2021 is here. There are some bright spots for sure, but the stark reality is that the work has only just begun. Recovery is going to be long and difficult, and Manitoba Chambers of Commerce will continue consulting with our business community about what is and isn't working. We need to know how best to help you and how to be an effective support and advocacy association. This year, naturally, we're focused on communicating about support programs and emergency financial relief that will help see us all through to the other side. Please watch for our next phase project, the Coronavirus Business Survival Guide. On behalf of the Manitoba Chambers of Commerce Board and staff, thank you to our members and to Manitoba's diverse and resilient business community. We know how hard you're all working. Up next in our webinar series, Manitoba Pulley Power Hour, we'll host Honorable Ron Schuler, Minister of Infrastructure, on February 16th from noon till 1. Please register online at jointhechamber.ca, and we hope to see you then. Stay safe, everyone. Thanks, Derek, again.
Thanks,
Derek.